Welcome to the All Financial Hour podcast with Steve All.
If you check out what people have in their retirement and you look at those sources of income there, it's usually from 5 places, and each of these are taxed differently. You have your IRA or 401k, then you have your Roth 401k or Roth IRA, maybe a brokerage account in there, an annuity, and then Social Security. So to keep taxes at a minimum, are you looking at each of these accounts to calculate how much to take from each one? How does that work?
It's a game that we get to play on a regular basis. We have a book that was written over 100 years ago that they don't think anybody's ever read the whole thing. And that's the IRS tax code. We have one of the most complex tax codes in the world. You know, as you just put it, IRAs and 401ks are both tax deferred. So therefore, when you take money out of them, they're taxed as ordinary income. So there's some different rules around required minimum distributions if you have to take those, but the taxation's still exactly the same. Your Roth 401ks or Roth IRAs, if you've held it for more than 5 years and in excess of 59 and a half, there is no tax on the distributions from a Roth IRA. They also don't have a required minimum distribution. So that's one of the other advantages of having a Roth IRA account. Brokerage accounts all over the place. You know, you got capital gains. Do you have short-term or long-term? And the idea around that is if you've held it for more than a year, that would be considered a long-term capital gains. Dividends and interest. Well, qualified dividends are taxed at capital gains rates. Regular dividends are ordinary income, and interest is at ordinary income. And then one of the more complex when it comes to taxation is annuities. Annuities in an IRA account are simple. Everything is taxable. But then when you get it in a non-qualified account, if you turn on an income, some of them will allow an exclusion ratio, so part of it's taxed, part of it's not. And if it's not in that category, it's the last in, first out. So if you have interest income or gains in a year, that comes out first. So they're more complex than it is. And then the one that most people, what do you mean I got to pay taxes on my Social Security? I said, yeah, that is part of the game. And Social Security depends on all your other incomes as to how much of your Social Security is taxed. There's thresholds. Those thresholds are for income limits. And it depends whether you're single or you're married. So we look at it to the point that taxes, when we're working and we predominantly have a W-2, most things are taxed exactly the same. In retirement, which part do we take it from? And that's what we have to look at. You know, are you getting a pension? Ordinary income. Social Security, how much of it's taxed? Do I have to take money out of my, quote, IRA accounts or 401ks to meet my living style? So that's what we have to look at, and that's one of the questions that we get a lot, especially at this time of the year, is I need X number of dollars. Where's the best place to get it from? And everybody's situation is usually going to be different. And as I like to basically say, reducing or eliminating taxes in retirement is one of the best things you can do for successful retirement. Give us a call. Let us do a tax analysis for you to find out where we might be able to assist you with that reducing or eliminating taxes in retirement. Give us a call. Ask for the tax analysis.
And if you'd like to come in for that tax analysis, give a call right now. We're going to do that complimentary for you listening today. That's 636-230-8824. 636-230-8824. Lots of great details about Steve and the team on the website, yourmoneymattersstl.com. You know, Steve, for a lot of folks, making this commitment to come in and sit down with you can be a little overwhelming. Paint that picture for that first appointment for me.
Let's look at it. First of all, you'll make a short appointment with our consultation coordinator, Chris. You'll talk with him for a little bit. He's going to ask some questions to make sure everything's going to go. He's going to give you a discovery form. It doesn't really matter if we're analyzing Social Security or a full complimentary review. we still need that information. We're going to need copies of statements. We're going to need to look at tax returns if taxes is your question. So those are the things we'll bring you in and we'll set you down. I like to figure out what retirement looks like for you. What are your wishes, hopes, and dreams? What are the things on your bucket list that retirement means for you? So those are the things that I would like to find out. Then we'll gather the data. You might meet with me. You might meet with Tracy or Will, but I know David is almost always in the room. He's our paraplanner. He's going to ask a lot of questions, and he's going to gather the data. It's going to take about a week or two after that, and then we're going to bring you back in, and we're going to give you a discovery of that plan that we looked at and how we could possibly benefit you in your retirement years.
It's as easy as that, folks. The hardest part really is picking up the phone and making that commitment, putting it on the calendar, and coming in. Again, that phone number, 636-230-8824. The website, yourmoneymattersstl.com. CBS Mornings followed some couples who are preparing to retire. And after a 20% market pullback in the spring, they revisited Chu and Alicia Gomez in Boston.
I feel like I'm on a roller coaster. You just hope that if we're going to be on the downturn now, will we be on the upturn when we decide to retire?
Yeah, I think a lot of folks might feel like they're on that roller coaster here. And the Gomez's, by the way, they're 57 and 59, and they still want the growth. But do they have to be on this market roller coaster at this point in their life? And do they have to be, and can they afford it, quite frankly?
Well, that's the question that we have. We have two different ideas that we've got with this question. One, the emotional roller coaster. And I like to put it ticks up very slowly if you've been to Six Flags and done that kind of stuff. And as that market's going up, it's like, I don't really know if I need an advisor. I'm going to retire early. And then all of a sudden, it's like, oh no, here we go. Is it going to, I may never retire. Oh, I'm just going to go ahead and get out. And then people quit. The emotions are what hurt returns more than anything else. I believe that your investment world should be based on need, not greed. So I think it switches when we start to look at. And we get a lot of people, it's like, well, I'm going to retire in 3 years. I need to go to cash. Well, that might not be the best plan because of the fact you still have to make money in retirement, because we're going to have this little thing called inflation that is going to make cost rise. 5 to 7 years ago, most people didn't talk about it, but they do now because we look at it a lot more. And then I would say that's the second thing that we start to come in with these folks is these people could have 25 to 35 years in retirement, retiring at 57 and 59.
That's right, yeah.
So, it used to be said that there's only three things that are important in retirement: income, and income. Mm-hmm. So we look at what you currently have that is going to be what we call guaranteed income. Social Security. Now, there's some possibilities of some changes, but I do believe that Congress will get on the wagon at the very last minute to allow Social Security to stay as it is. Pensions. Not as common today for the younger people as they are for our parents and a lot of our generation. Annuities. Annuities are, like a personally funded pension. All they're doing is they're saying, we are going to pay you this amount of money every month, year, quarter, however you want to be paid for the rest of your life. If you would prefer it, you can add and do it for both. So that's where we start to look at is where do we go? There are things that we can do to protect the asset. The annuity world does have a fixed indexed annuity that your money cannot go down due to market volatility, but it does participate in the market when the markets go up. It could be caps, spreads, participation rates. There's a lot of different rules around that. They're not as simple as they were. So if you've got an interest in that, we can talk about how you could protect yourself that way. And then you look at that income. So my statement of it is, are you prepared for whatever happens? Because she said, I hope I don't retire when the market's down. I want it to be up. Well, the only promise I will make, Compliance usually doesn't let me guarantee a whole lot, but I can guarantee the market's going to do one of three things. It's going to go up, it's going to go down, or it's going to stay the same. I don't know when it's going to do that. So if you need to be prepared for whatever happens in the market. And that's why I'm saying, if you're not sure, when can I retire? In their case, would I run out of money? And how am I going to replace that paycheck? Give us a call. Ask about that comprehensive retirement plan. Allow myself and my team to sit down with you and show you what your probability of a successful retirement is. Give us a call now. Ask for the comprehensive retirement plan.
And again, this is complimentary. And I love what you say there. It shows you the probability that you're going to have. And again, when it comes to income and riding that roller coaster, you have to remember you need to be prepared for anything coming your way, even the uncertain things. You want to have an income plan, not an if-come plan. And that's what this comprehensive retirement plan is going to do for you. That phone number, 636-230-8824. That's 636-230-8824. The website, yourmoneymattersstl.com. You know, around this time of year, there's usually talk about whether the stock market will experience what they call a Santa Claus rally. And portfolio manager Jason Katz, he tells Fox Business that the market is primed for one.
The narrative in equities is still alive and well. It's driven by strong earnings, rates going lower, the economy. So we've had a year of V-shaped recoveries, whether it was DeepSeek, Liberation Day, private credit concerns, AI jitters, rate cut fears. I think we're going to have a year-end rally. The buy the dip crowd, the FOMO crowd, the underperforming professional money managers. This is the season to be long.
Okay. Wow. All right. Well, whether a seasonal rally becomes real or not, isn't this a reminder to check whether our portfolios drifted too far into stocks this year and we need to do a little rebalancing?
Yeah, that's one of the things that most people don't do. Modern Portfolio said if you buy a good basket of goods, hold on to it and rebalance on a regular basis, you got a chance for a decent return over time. Well, that's the part that usually gets missed, is the rebalance. I remember a good friend came in, sat down, and we talked. And we'll do the risk-reward analysis for everybody. And I usually like to ask the question, on a scale of 1 to 10, where are you at on the risk-reward scale? I'm a 1. Okay, that's great. Okay. Now, we're going to do this analysis. And when I got the analysis back, she was 95% invested in equities. And she came in and I went, you know, you said you were a 1 and I've got you as a 9 or a 10. And she goes, oh, I started putting money in my 401k 40 years ago and I never changed what I did.
Woo, yikes.
Yikes. Yes, yikes. Now she's 2 to 3 years out from retirement and she's still in a very aggressive portfolio. So I think that's important that when we look at it, but when we start to look at the balancing, I think we have to take the emotions out of it. You know, I want that methodical, non-emotional, mathematical approach to these types of things. When should I hold? When should I sell? And if I did sell, when can I get back into the market? And that's where I believe having that non-emotional mathematical formulas to assist with how your portfolios are going to be done. I like our static portfolios. They just adjust for drift. Because as it said, if you had an 80-20 portfolio and a pretty good year this year, you don't have an 80-20 portfolio anymore. You might have a 90-10. Okay, so when the market does start to go down, you're going to take more risk when it goes down. What if it went the other way? What if it was one of those years when it was down? You don't have an 80-20 anymore. You got a 70-30. What happens a lot of times when markets go low? It starts to come up. And I think the annual rebalance is very important for portfolios. And it's usually the part that people do not do. So if you're looking for that idea around how do I mathematically figure out, should I sell? Should I just hold and where I'm at? Or if I did sell, when do I get back in? If you'd like that, call. Ask for a risk-reward analysis. Allow myself and my team to assist you with getting the most of the emotions that we possibly can out of the investment world. Give us a call now. Ask for that risk-reward analysis.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.